Time here from my friend Bill Janeway. Those of you who are FiRe returnees are very familiar with Bill. He's been here, I think, every year we've done FiRe.
So.
And this conversation, although shortened today, has become an important tradition, I think. I'd go that far. Generally, what I do is I ask you one question, and then 30 minutes later, I ask you one more question, and then we get off the stage. So we'll just truncate that to 10 minutes or so.
Right.
And the question I'm going to ask you is, tell us your view of this kind of, it's almost a blow-up, a boom in buyouts and debt equity, private debt equity finance transactions.
Sure. We talked a little bit about this last night, Mark. I think at the high level, this sort of macro overview, there are three quite fundamental institutional developments that have fed and fueled, if you pardon the expression, an extraordinary increase in the availability of credit and an extraordinary reduction in the cost, both the actual price, the interest rates, and the terms of debt. And that's what's been fueling this phenomenal buyout boom. The three factors are, first, over the last now more than 30 years, the major central banks, the Federal Reserve here, the Bank of England as the lead bank in Europe, have convinced the markets that when something bad happens, whether it's the first oil crisis in the 70s, the crash of '87, the Asian flu, the Russian collapse, the long-term capital management fiasco, or closest to all of us, the busting of the dot-com telecom bubble, anything like that happens that threatens discontinuity in the capital markets, the central banks will do what they have to do to keep the system alive, to keep the system going. So the economists call this moral hazard, but the notion is that the authorities will underwrite risk. Second, in this country, finally, about 2-3 generations after Europe and Japan, the banking system has been consolidated. No more than about a dozen banks today represent 90% of all the liabilities, all of your deposits, which means that every one of them is too big to fail. The U.S. went through the Great Depression and even through the 70s with banks failing, with fear following. That's over. And then finally, and most recently, and I guess I'd have to say generating the greatest uncertainty about where we go from here, in 6 years, beginning just in 2000, about the year 2000, a new market has been created, the market in credit derivatives. It began when banks started amalgamating your credit card debt, your mortgages. That goes back to the early 80s, but it really exploded in the last 6 years. This market has gone from $0 to $40 trillion in 6 years. What it means is that a lender, a bank, an insurance company, makes the loan and immediately can either sell the loan to the market being hedge funds, high net worth individuals, remote banks and insurance companies and mutual funds, or it can write a contract. It can take out, in effect, an insurance policy that says if the borrower goes bankrupt, you'll pay me the money that I lent. These insurance contracts have been aggregated. They're called collateralized debt or collateralized loan obligations. They're aggregated by the big banks. They're sold in tranches so that at the most secure end, half the loans would have to go bad before you lose any money. You're providing the insurance. That's AAA. At the low end, the equity tranche, if it's just one out of 20 borrowers goes bust, you lose all your money. This market has just absolutely exploded. What it means, coming back to the buyout industry, to the private equity firms that have access to this credit, is that nobody's really minding the store. Nobody owns the loan who is close to the borrower and cares. And that's led to the latest phenomenon, which for a lot of us, it just takes our breath away. When you actually borrow money to buy a company today, yes, you agree that in principle, it's in the contract, You won't, your interest payments won't be more than a certain amount relative to the cash flow, the total debt relative to the assets. There'll be these covenants,
yeah.
except nobody's going to check. They're called Covenantlite loans, which means there's no requirement to tell the borrower, to tell the lender how you're doing. At the end of the day, you're supposed to pay the money back.
Yep.
That is still the case. It is still a loan.
But there's no foreclosure, there's no.
So it means there's an enormous amount of time. That's why this boom can go on even while stress and strain builds up, even while the pricing means that at the end of the day, when you actually start adding it up, the rates of return on these investments will not be very attractive.
And there's no way to call these loans.
There's no requirement to call the loans unless there is an event, major acquisition or a merger, change of control. I guess there's one final factor, which I'm a little old-fashioned about this, coming out of the venture world as I do. The big buyout firms that you read about doing these deals have three sources of getting paid, not just two. They get a management fee on the funds they raise. They get a share of the profits in the growth in the value of the underlying equity of the businesses they buy. But they also get what are called transaction and monitoring fees. So that you close a $10 billion buyout, well, Freescale, the semiconductor company, the old Motorola semiconductor company, was acquired by two buyout firms for $17 billion. At the closing,
Blackstone, right? Yeah.
no names, no Pactril, but you can look it up. They paid themselves a $300 million fee at the closing for having closed the deal. They shared some of that with their limited partners, with their investors. Most of it went to the general partners. During the course of owning any of these businesses, while they're getting the management fee from their investors and they're getting a share of the profits if there are profits, they're also charging a fee every year for being there, for going to board meetings. Now,
So there's an investment bank face to this.
well, that's right. That's right. And I'm enough of an old economist to believe that behavior follows incentives. And if you're getting paid for closing a deal, whatever the terms and you're getting funded to do it on a basis which says, I'm really not going to, how can I lose money? This activity will continue independent of the underlying economics. It is a phenomenon that you have to believe sooner or later there will be an event. Sooner or later, the notion that you're in lending to buy a business on a basis which says the cash flow just covers our interest charges, that something will happen and credit spreads will rise, that the lenders will, through the market, there will be concern. We had a little episode of this a couple of months ago in February. It looked like there might be something, but no, everything smoothed out again. It is when you have a system this highly leveraged, sooner or later you do tend to get a discontinuous reversal.
There are a number of well-known investors who are talking about
That's right.
the lack of regulation of derivatives and how scary that is.
That's right. And I will say that the regulators, the Financial Services Authority in Britain and the New York Federal Reserve Bank, those are the two guys with their eyes on the ball. They really do have a keen sense of what's going on. What they're going to do about it is a challenge. Everyone grows up remembering that in 1931, as the U.S. economy was the drunk starting to fall downstairs.
Tell me again, who are those two groups?
The Financial Services Authority in Britain is the amalgamation of all, the British put everything into one regulator.
Right.
So it's the old regulatory arm of the Bank of England. It's their equivalent of the SEC. It's their equivalent of the controller of the currency. It's all in one.
So that group and?
The New York Federal Reserve Bank.
New York.
Yeah.
Just New York.
Yeah. That is where the capital market oversight, and Tim Geithner, who's the president of the New York Fed, is outstanding.
And you think that they have a clear view of derivative exposure?
Yes. I do think that they have a clear sense at the center of this enormous network. What they don't know and what they can't know are all the daisy chain connections
Well, that's what I mean.
of
The ifs, ands, therefores are
That's correct.
unique to every deal.
if something breaks, they will know just about as soon as Goldman Sachs knows.
Yeah.
And that means in milliseconds
Right.
that there's a problem. As I say, what they
But they
do
won't know what these
about
ifs,
it,
ands, and therefores are, and so it's hard to know how far the...
they can provide liquidity to JP Morgan Chase, Citicorp,
Yeah, yeah.
Goldman Sachs, Morgan Stanley
Yeah.
to keep things going. But if they do that again, the mountain of moral hazard grows ever larger. There was an old, and maybe this is about how to finish, there was a great British economic and financial advisor and analyst who was the editor of The Economist magazine for years and years, named Walter Bagehot. This is in the 1870s, 1880s, 1890s. He wrote a book on the money market, and he sort of developed a kind of thesis which, to simplify and summarize, was when a bank goes bust, you have three categories of players. You have the depositors. They're the innocent bystanders.
Right.
They should be held harmless. They should get their money back.
Yeah.
That's what the bank should, the Bank of England should make sure they get. You have the stockholders. Well, they took a bet. They were risk investors. They lose their money.
Yep.
Then you have the management. They go to jail. That's how you deal with moral hazard.
Right, right. I want to ask you, we have just a bit, I want to ask you one more question about this whole thing, and it's, I want to go back to February for a moment, because
Yep.
I was in England when this happened, and I came to a conclusion which was in line with the FT, but quite different from everybody else, and that was more and more, less and less about China. Everyone was saying this is a China-related, well, I don't think it was, and more about Japan and the carry trade. And looking at who's in that, who's taking money at 0% essentially, and where's it going, you know. And it seemed to me, one of the things, the FT estimated that the carry trade, the size of the carry trade was around $250 billion. And I started to think, the more I looked at that event in February, that was too small.
I think you're probably right.
And that the real number is going to be 500 billion to $1 trillion, somewhere in there. Because it was able to push the Bank of Japan around, and it's pretty hard to do that. So I'm wondering if that particular thing, the carry trade in Japan, which means borrowing money at zero interest rates and reinvesting it, just as these guys are doing.
Which means, and
how much is this fueling?
Well, this is the point, because it looks like a simple bet. You borrow at zero and you invest at 4% in the U.S. in treasuries, and you make a lot of money, and then you can leverage that position. Except, of course, you're exposed to the yen going up and the dollar going down.
That's right.
So you didn't borrow at 0% in dollars. You borrowed at 0% in yen. And you got to pay back the yen, and it may take more dollars to do it. So that's the risk.
And the other risk is the Bank of Japan has publicly stated that as a matter of policy, they will continue to raise these rates.
Right. So that is one of the numerous points of exposure to this, seemingly endless
Is that free
chain.
money driving a lot of this behavior?
It certainly is feeding into it. I think that probably more than anything else, it's the credit derivatives market and the perception on the part of the lender that they are going to get a fee for structuring a loan, but they're not going to be at risk for the repayment of the loan.
But
That's
don't
the
you think
biggest
that
new
if you
thing.
took the whole derivatives market itself, that's listed as one of maybe four, that plus hedge funds plus as four of the guys who are benefiting from the carry trade.
Well, but everybody's a participant. The hedge funds are in the carry trade. The hedge funds are in the credit derivatives markets.
Right. It's truly a mess.
Yeah, it's one enormous organic. What is the great Santa Fe line? It's an emergent behavior of a complex evolving system.
Thank you very much.
Great.